Hello and welcome to this section on FINRA underwriting rules. In this section, we're going to take a look at some of the specific rules and regulations FINRA imposes upon underwriters and syndicate members to ensure that all offering of securities is indeed reasonable and that the compensation received by underwriters is reflective of the effort put forth by the underwriters and that the compensation is not excessive. To ensure that the compensation is not excessive, FINRA requires all underwriting agreements to be filed with its Corporate Finance Department, or CFD. The underwriters must file the underwriting agreement with FINRA's CFD within 1 business day of when the registration statement has been filed with the SEC. So if the issuer files the registration statement, or S1, with the SEC on Monday, by Tuesday, the underwriters must file that underwriting agreement with FINRA's Corporate Finance Department. This is going to be done by the lead or managing underwriter, and FINRA wants to inspect the underwriting agreement to ensure that all compensation is indeed reasonable. Now, what if the offering is exempt from filing of a registration statement with the SEC? Well, if the underwriter is underwriting an exempt offering, perhaps a private placement, the underwriting agreement must be filed with FINRA's Corporate Finance Department at least 15 business days prior to the offering date of those securities. Now, let's take a look at what's disclosed to FINRA's Corporate Finance Department when that underwriting agreement is filed with the CFD. One of the things they're going to want to know is the maximum offering price for the security and the maximum underwriter's discount. What is the total spread or maximum spread to be earned by the underwriters? They'll want to know what the maximum reimbursement for underwriters' expenses is going to be. Underwriters' compensation is made up of many things. The underwriting discount or the spread is certainly the largest component of that underwriter's compensation. However, there are a number of other things that FINRA determines to be compensation to underwriters. And that could be options, rights, or warrants, or shares of the stock to be provided to the underwriters. Clearly, that is compensation to the underwriters. Any finder's fee reimbursed by the issuer. What is a finder's fee? Well, let me see if I can give you an example to help you understand this concept. Let's say your college buddy and you are playing golf one day, and he says, you know, my neighbor has started a very large tech firm, and he's considering going public and is looking for an underwriter. I know that your broker-dealer is very active in the underwriting of technology companies. If I bring this deal to you, do you think you could pay me a finder's fee of $250,000 for bringing that deal to your broker-dealer? And the registered rep says, yes, I think we can get that done for you. So the registered rep goes to his compliance department and his higher-ups, and they bring in the deal to the investment banking department. The underwriting agreement is signed with the neighbor, and the college buddy receives a $250,000 finder's fee. Now, if the company being underwritten reimburses the broker-dealer for that $250,000 finder's fee, that's deemed to be part of the underwriter's compensation because finder's fees are not traditionally borne by the issuing company. That would be an expense borne by the underwriters, and the reimbursement of that expense constitutes compensation in the eyes of FINRA. Non-accountable expense allowance. Broker-dealers who are doing these underwritings are going to want to have a certain amount of money set aside in a small pool to cover expenses that they're not going to be required to document, T&E type of things, so to speak. But that is considered to be underwriter's compensation. Non-allowable expense allowances to cover travel, entertainment, things of that nature. Other things that go into the underwriter's compensation is the over-allotment provision or green shoe provision. That constitutes compensation to the underwriter. Any right of first refusal on future deals. For example, we bring you public, we want the right of first refusal for any securities you're going to issue for the next amount of time. That is deemed to be compensation. Any trail or breakup fee. If the issuer decides to cancel the issue or decides to go with another underwriter or syndicate, the issuer would be required to pay the underwriter that they have left a breakup fee. That constitutes compensation. And any fees received by the underwriters or the broker-dealer or the syndicate members within 180 days of the underwriting. The look-back period is 180 days, and that all goes to compensation of the underwriter. And these are the things that FINRA's Corporate Finance Department look at to determine whether or not the total compensation is deemed to be reasonable in the eyes of FINRA. Now, they put some pretty strict rules on what constitutes unreasonable compensation or excessive compensation. If the underwriting spread or discount is too large, FINRA is going to kick it back. It's going to say, no, come up with another number. This discount or spread is too much. Any options, rights, or warrants that are exercisable below the public offering price. If the stock is coming public at $25 per share and the underwriters are granted options, rights, or warrants to buy the stock at $20 a share, well, that's unreasonable. That FINRA would never allow that. That's deemed to be excessive. Any options, rights, or warrants that allow the underwriters or syndicate to buy greater than 10% of the offering, or that have an expiration or a term of longer than 5 years, FINRA will deem that to be excessive and kick the underwriting agreement back to the underwriters to come up with a more reasonable structure. If the underwriters are going to receive stock in the company they are underwriting, and the amount of stock to be received is greater than 1% of the total shares, and that stock is not locked up for at least 6 months, FINRA will deem that to be excessive and will not allow the underwriting to go forward. Any non-accountable expense allowance greater than 3% of the offering would deem to be excessive. That would be too great of a non-accountable expense allowance and could be subject to abuse. A green shoe provision, which gives the syndicate or the underwriters the ability to sell more than 15% of the offering in additional shares, that would be deemed to be excessive. That 15% green shoe or over-allotment provision is indeed the maximum allowed under FINRA's regulations. Any right of refusal for future deals greater than 3 years would be deemed to be excessive. We want the right of first refusal for any deal you do for 5 years or 10 years or in perpetuity. That would be excessive in the eyes of FINRA. Any trail or breakup fee required to be paid by the issuer for greater than 2 years, that also would be deemed to be excessive. So it's a good thing to have a handle on the items that are deemed to be compensation, as well as those levels that would be deemed to be excessive compensation, tested on a lot of exams for most of you. Now, what would not go into underwriter's compensation? Well, if the issuer reimburses the underwriters for expenses that are the responsibility of the issuer, that would not be deemed to be compensation. Printing costs, prospectuses, things of that nature, that would not be deemed to be compensation to the underwriter. Accounting fees, those would normally be borne by the issuer. And blue sky fees, registering the shares in all the states where the shares will be sold, those fees are traditionally borne by the issuer. And while the underwriters may assist with that registration, those fees are required to be paid by the issuer. So if the underwriters lay out those blue sky fees on behalf of the issuer and the issuer reimburses those, that's not deemed to be underwriter's compensation. Now, what type of securities are not required to have their underwriting agreement filed with FINRA's Corporate Finance Department? Well, U.S. Treasury securities and government securities, municipal securities, open-end investment companies, and unit investment trusts, redeemable shares of an issuer registered under the Investment Company Act of 1940, variable contracts, variable annuities, and variable life insurance policies would not have their underwriting agreement filed with FINRA's Corporate Finance Department. So that's a really good review of the type of compensation and the requirements to file the underwriting agreement with FINRA's CFD and those instances when they would not be required. Now, we need to take a look at some special rules that come into play when a FINRA member firm is raising money or going public. A FINRA member firm, meaning Goldman Sachs, Merrill Lynch, Wells Fargo. These members are also issuers in this case. A broker-dealer who is going public may not sell their own shares to investors. They must have a qualified independent lead underwriter, meaning they must go to another broker-dealer who has experience underwriting securities and meets a definition of a qualified independent lead underwriter. A qualified independent lead underwriter is an underwriter that has been the manager or the lead on 3 deals in the last 3 years where they took down at least half or 50% of the offering. So again on that, a qualified lead underwriter is an underwriter who has been the manager or the lead underwriter in at least 3 underwritings in the last 3 years where they were responsible for marketing at least 50% of the shares sold. That is the definition of a qualified lead underwriter. Now, here's a little bit of a subtle twist here. When a FINRA member firm is going public or raising money, the underwriting agreement is required to be filed by the member raising the money, not by the underwriter. Let me say that again to you. If a FINRA member firm is selling securities, raising money, the member firm that is the issuer is required to file the underwriting agreement with FINRA's Corporate Finance Department, not the underwriter. That's a little bit of a twist. Now, what if the member firm was raising money through a private placement, not through a public offering of securities? This is known as a member private offering, or member private placement is a member private offering. They are going to raise money through a private placement to operate or expand their broker-dealer. Now, the term sheet that's going to be used as the placement memo or offering memorandum is required to be filed with FINRA 10 calendar days prior to the effective date or the offering date. They must file the placement offering memo, term sheet, memorandum, however they present it to you on the test, 10 calendar days before the offering date. Now, you can see where a member broker dealer may try to raise money to help ensure that it doesn't get into financial difficulty or, God forbid, go out of business. So when a member firm raises money, either through a public offering or through a member private offering, an MPO, those monies will be held in escrow, meaning they will not be released to the broker-dealer until the broker-dealer does a net capital computation. They must perform a net capital computation in order to demonstrate to regulators that they are in good financial condition. Now, when they do that calculation, they must show that their AI, their aggregate indebtedness to net capital, is less than 10 to 1, or that they have 120% of their required net capital. Let me say that again. before the money will be released to the member from the escrow account, the member firm must do a net capital computation. And that net capital computation must show that their aggregate indebtedness to net capital is less than 10-to-1, or it must show that they have at more than 120% of the required net capital. Either way, once they perform that calculation and it shows that those numbers are in line with the requirements, the funds will be released to the broker-dealer for their use. Now here's the test point. The money in the escrow account can be used in the member firm's capital computation. So whatever money is being held in that escrow account as a result of the offering can be counted towards allowable capital, and once that capital computation is performed and demonstrates good financial standing, the proceeds will be released to the member. Now that's a great review of the specific requirements for FINRA when underwriting securities and when a member firm is the issuer. Some really solid test points there. We would like you to go back to your book and to review the details a little more thoroughly and to take some test questions in our test bank. We'll see you in the next section.